Well, good afternoon, and thank you very much for inviting me to speak here at the IPA National Conference. Today, I'll be focusing on recent work that ASIC has undertaken in relation to self-managed super funds and our proposed work over the coming months. And just as a housekeeping announcement, so I'm not continually referring to SMSFs throughout this afternoon's presentation. I'm just going to refer to funds on many occasions. But the focus is clearly around self-managed super. So by way of background, in September of last year, ASIC Deputy Chairman Peter Kell and ASIC Commissioner Greg Tanzer became jointly responsible for heading up ASIC's Self-Managed Superannuation Fund Task Force. This task force was set up in response to the growth of funds, an increase of geared investment strategies within those funds, the collapse of an investment firm, Trio Capital, and a parliamentary inquiry into that collapse. And the task force's main purpose is to examine high-risk issues in this fund sector. Now, as I'm sure all of you will know, this sector is growing rapidly, and more Australians than ever before are either considering or operating an SMSF. Today, I'd like to focus on three things in making comments to you. First, the critical important role of what we would call gatekeepers in this sector. Second, our focus on these funds and our review of the quality of advice provided to SMSF investors. And third, a recent consultation paper on disclosure and costs relating to these funds. As many of you will already know, these funds are the fastest growing sector of the superannuation industry. Our primary role in relation to these funds is to regulate gatekeepers, the accountants, financial planners, fund auditors and providers of products to self-managed super. ASIC also regulates many, but not all, of the financial products that these funds commonly invest in. And from that perspective, we are very keen to ensure that fund trustees are adequately equipped to make good investment decisions, being fully informed about risks and returns. The decision to establish one of these funds is often one of the most significant steps an investor can take in relation to their retirement savings. And many investors seek professional advice from an accountant or a financial advisor before taking that step. It's essential that investors have access to good quality, tailored advice that's in their best interests before making the decision to set up a self-managed super fund. The important role of accountants as gatekeepers in this process has been recognised in recent legislation. Two key reforms, just as an example. First, the introduction of a new limited Australian financial services licence to provide advice about these funds, and secondly, the reforms about the registration of fund auditors. Let me turn firstly to the topic of the limited licence. As you'll be aware, from the 1st of July this year, accountants have been able to apply for and obtain a limited Australian Financial Services or AFS licence from ASIC. And this replaces the current accountancy exemption from licensing when giving advice to set up a fund. A limited licence allows people to give advice not only on these funds, but also on certain classes of products that the funds might invest in. Any person may apply for a limited licence. However, recognised accountants, and that includes members of the IPA, who apply before 30 June 2016, will be able to take advantage of various transitional arrangements to make entry into the licensing regime a little easier. Under these transitional arrangements, reduced requirements will apply where responsible managers of the licensee applicant are recognised accountants, such as members of the IPA. However, once that transitional period is over on 1 July 2016, all new applicants will need to meet the full requirements under the law. Now, in implementing this new regime, ASIC has been mindful to try and reduce red tape. We've taken advantage of these changes to our licensing process to remove close to 50 licensing questions from our forms. And in addition, to help reduce the costs of operating within this licensing regime, holders of a limited licence can lodge a compliance certificate on an annual basis rather than undertake an external annual audit of their financial statements and internal controls. This exemption from the annual external audit requirement will be available to limited AFS licence holders who do not hold any client money in connection with the provision of their advice. However, it's important to note that apart from the annual compliance certificate, holders of this limited licence will need to meet the same ongoing requirements that other financial advisors also need to meet. And that includes licensing and conduct requirements, things like providing documentation when advice is given in a statement of advice and being a member of an external dispute resolution scheme. ASIC's provided quite a deal of guidance to help people through this licensing process, and in particular I'd refer you to an ASIC information sheet 179, applying for a limited AFS licence, which is available on our website. Since the 1st of July this year, when this regime kicked off, we've received 24 applications and we've issued 7 AFS licences to date. And of those 24 applicants, 4 have been members of the IPA. I want to turn now to say some brief words about self-managed super fund auditors. As part of the Stronger Super initiatives, ASIC became the registration body for approved fund auditors from 31 January this year. This reform recognises the key gatekeeper role that approved fund auditors play. The objectives of these reforms is to raise the standard of audit competency and to ensure there are minimum standards right across this sector. To audit a fund now, you must be registered with ASIC as an approved auditor. In fact, it's an offence under legislation for a person to hold themselves out as being an approved fund auditor when they're in fact not. To assist people get registered, we released regulatory guidance, ASIC Regulatory Guide 243, Registration of Self-Managed Super Fund Auditors, in January this year. To be eligible for registration, you must have passed a competency exam within the previous 12-month period before you apply. However, for those people who applied before the 1st of July 2013, you got a 12 months grace period, so you won't need to sit the exam until 1 July 2014. Through our exam provider, Assessment Services, ASIC has received approximately 450 exam bookings and delivered around 220 self-managed super fund auditor exams. We're anticipating that in the first year of the reforms, over 1,800 exams will be conducted. The pass mark required for these exams is 65%, and so far about 80% of people who sit the exam have passed. Candidates are generally given 2 attempts at the exam, but to date very few people have taken up their second attempt, only around 10% in fact. And we think what is happening is that people who have failed the exam on the first occasion are doing further training before they sit the exam again. Since the introduction of this auditor registration regime on 31 January, we've received over 7,300 applications and we've registered and approved over 7,000 self-managed super fund auditors. Now, with the establishment of a public register about these auditors, for the first time, fund trustees are able to identify suitably qualified auditors to conduct a self-managed super fund audit. We hope that among those using the register, there are accountants such as people in this room who will use the register to verify that the auditors they're referring their clients to are actually registered with ASIC to conduct the audits. And the facts are that this registration searching facility has been enormously popular. In late October of this year, nearly 80,000 fund auditor searches had been conducted through ASIC's website. By being able to provide and identify approved self-managed super fund auditors, that should promote a level of confidence that the sector is meeting minimum standards, and it also identifies auditors that ASIC or the ATO may need to contact and update on an urgent basis. So clearly it's a very useful tool. I want now to focus on the other work that we're doing through our self-managed super fund task force. As I mentioned earlier, the purpose of this task force is to examine high-risk issues for these sorts of funds. As its first major project, the task force looked at the quality of advice given to fund investors, with our overarching aims in this area being to ensure that only investors for whom a self-managed super fund is suitable are advised to establish one, and secondly, that fund investors are getting good quality advice and services from key gatekeepers. In April of this year, we released a report, Self-Managed Super Funds Improving the Quality of Advice Given to Investors, which sets out some results from a review we conducted in 2012 into the quality of this advice. It's important to note that we deliberately targeted files that we thought might be more at risk. So we only looked at funds with a balance of less than $150,000, and we only looked at investors who, for example, were older or had lower incomes, or where the self-managed super fund borrowed or invested in a single asset class only. While our report found that the majority of advice provided to fund clients was of adequate quality, it did highlight some concerning pockets of poor advice, and much of this advice involved recommendations that investors set up a fund to gear into real property. Through our reviews, we did also find areas where there was room for improvement in respect of giving advice about self-managed super funds. Where we did find problems with advice, it tended to be in the following areas. First, the advice was not sufficiently tailored. Replacement product disclosure was absent or inadequate. Insurance recommendations were absent or inadequate. And any appropriate single asset class strategy was given to investors. Suitable alternatives to self-managed super were not considered, or there was inadequate consideration of the investor's long-term retirement planning objectives. And notably, we also found that investors were not warned about the real risk of not having access to a statutory compensation scheme in the event of theft or fraud. So as the next stage of our task force work, in September of this year, we released a consultation paper, and that consultation paper is public and still open for comment. And that consultation paper 216 is about advice on self-managed superannuation funds, specific disclosure requirements, and self-managed superannuation fund costs. So let me talk about the disclosure requirement. We are actually proposing to change the law to set out some specific disclosure requirements for AFS licensees and their authorised representatives who are giving personal advice to clients about establishing or switching to a self-managed super fund. And the sorts of disclosures we are considering introducing are around things like the duties and obligations associated with running a fund, including that trustees remain responsible for managing the fund even if they outsource some or all of their responsibilities. The risks of running a fund, the need to develop and maintain an appropriate investment strategy, the time commitment and skills needed to run a fund effectively, the costs associated with running a fund and indeed winding it up should that be needed, the need to consider an exit strategy, and the possibility that laws or policies could always change about a self-managed super fund. So that's some disclosure requirements we're thinking about introducing. But that's only the first part of the consultation paper. The second broad issue that's covered in our proposed guidance is around fund costs. Now, whether there should be a minimum fund size balance for self-managed super has long been an issue of debate. Many industry participants question whether a fund with assets of less than $200,000 can be cost effective when compared to an APRA regulated fund. And within industry, there's also a lack of consensus at times on the costs associated with setting up, running and eventually winding up a self-managed super fund. In our view, it's very important to consider costs when making a recommendation to someone, providing them advice, to establish or switch to an SMSF. So in late 2012, late last year, we commissioned Rice Warner Actuaries to examine the minimum cost-effective balance for these funds compared to APRA-regulated funds. And we decided to publish that report, that actuary's report, to get feedback about the actuary's findings. And the purpose of all of this was simply to encourage further debate and explore issues around self-managed super costs. The actuary's research found that there was a range of costs that reflect the range of complexities within self-managed super itself. The actuaries found that for fund balances with less than $100,000, these funds are not competitive in comparison with APRA-regulated funds. It found that for fund balances of $100,000 to $200,000, self-managed super can be competitive with more expensive APRA-regulated funds if the trustees are willing to undertake the broader investment and administrative functions. It found that for fund balances of $200,000 to $500,000, they can provide equivalent value to APRA-regulated funds if the trustees undertake some of the administration. And for fund balances over $500,000, self-managed super can provide equivalent value to APRA-regulated funds on a full service basis. To be very, very clear, ASIC is not proposing a mandated minimum balance for these funds. Rather, we're looking to promote debate and provide further guidance on this issue based on research and industry and investor views. Now, we recently held 2 separate round tables in relation to our consultation, one for industry stakeholders and one for consumer representatives. Overall, stakeholders supported the disclosure proposals that we had put forward in our consultation paper. A number of industry associations noted that their members already comply with the disclosure proposals that ASIC are putting forward. And this is encouraging to us, both in terms of consumer protection, but also because it means that industry would be able to implement the proposals with minimal cost and disruption should we decide to proceed with them. One concern that was raised with industry was whether these proposals are a signal that ASIC is looking to introduce prescriptive disclosure requirements for other sorts of financial products. As we said at the round table, and I'll say it again today, that is not on the cards. That's not on the cards. Some stakeholders also noted that the proposals cover issues that are also contained in the trustee declaration that trustees give the ATO. Now, I should say this isn't at all coincidental. We look closely at the trustee declaration in developing our own proposals, but a key difference between the ASIC proposals and the trustee declaration is that trustees get the declaration after they've already signed up to get their self-managed super fund. And our proposals are designed to ensure that trustees get this information before then, so people can use the information to decide whether a self-managed super fund is the right thing for them. Now, we fully appreciate that industry is busy coming to grips with a number of regulatory changes, so we provided a 2-month consultation period on the various proposals I've mentioned today, with the date for submissions closing next week. But if people need more time to provide submissions, we're obviously open to that. By early next year, we want to be in a position where we can finalise any next steps that we wish to take, fully informed by the public consultation process that we've undertaken. And we look forward to working with you in the coming months to improve self-managed super fund advice. Now, in concluding, as I said before, ASIC is focused on encouraging gatekeepers to lift the standard of their advice so that investors can be confident and informed about this critical sector. I hope that today I've given a sense to you of some of the work that ASIC is doing in this sector and the important gatekeeper role your industry plays to make sure that the sector remains vibrant, healthy and safe for investors. Thank you very much for your attention.